If you want to be a part of the conversation before it happens here on YouTube, click that link in the description to join the free Courtside Financial Discord. What's going on, everyone? My name's Obi, and welcome back to the Courtside Financial Podcast, the podcast where we talk about business and technology. I'm pretty excited today to talk about a company which I'm sure most of you know is very near and dear to my heart. That company is NIO. We're going to be talking about their Q2 numbers. They just released their Q2 report yesterday, which was Thursday. Had another video that I had to get out for my content schedule, so I'm finally getting around to talking about this. Well, we'll talk deliveries, revenue, and their long-term strategy, as well as if I think that they're on the right path here after hearing what they had to say in their Q2 earnings and looking at the numbers. So this is going to be a super interesting, super exciting, super insightful video. If you're new to the channel, make sure you hit that like button, make sure you hit that subscribe button, click that notification bell icon, and leave a comment down below. All your engagement really does go a long way in helping out the channel, helping us to reach a broader audience and continue making content. So thank you for that. Thank you for your support. And without further ado, let's get into today's episode. So let's start with the headline number. NIO's revenue for the second quarter was a record-breaking 17.446 billion yuan, almost doubling, 99% growth compared to the same time last year. And to put that into perspective, it's not just about the number of cars sold, but also about NIO's abilities to ramp up production, streamline their operations, and ultimately just improve efficiency around the business. Think about that for a second. 99% growth. We're talking about a company that's navigating through the complexities of a global supply chain, increased competition, and inflation. So when I see numbers like that, it tells me that NIO isn't just keeping up with the competition, they're setting the pace and they're pushing boundaries. And trust me, this is an industry where pushing boundaries is going to separate the winners from the losers. Now I want to zoom in on NIO's gross profit. It's a key indicator of a company's health, especially in the EV industry. For an early stage company like NIO. NIO achieved a gross profit margin of 9.7 in Q2, which is up a mere 1% from the same quarter last year. That's a massive improvement, over 1,800% in gross profit. And you have to give credit to Li Bin and his team because the margin game in the EV space is notoriously high. Tesla, for example, has been a benchmark in this arena, and NIO is clearly trying to follow their playbook just a little bit. But here's the interesting part. NIO's aiming for a long-term gross profit margin of 25%. Now, 25%, some might say that's a dream, right? Well, it's certainly not happening overnight. This is a long-term goal, and it's going to require some strategic move. They've got to focus on higher margin models, improving product efficiency, and ultimately just continuing to scale. NIO's making it clear that they're in this for the long haul. But let's talk deliveries. This is where NIO's really showing some strength. They delivered 57,373 vehicles in Q2 alone. Just to give you context, that's an increase of 143.9% from the previous year. And these aren't just any vehicles. They aren't just micro EVs. These are premium high-end electric SUVs and sedan, which dominate the market. That's over 300,000 yuan. So what does this mean for NIO? Well, they're owning the premium segment of electric vehicles in China. While a lot of competitors are racing to the bottom, the micro EV market, as we like to call it, NIO's holding strong with their position in luxury. And with the release of their new ONVO L60 that's set to go head to head with the Model Y and is priced 30,000 yuan cheaper than the Model Y. They're clearly going to challenge Tesla in a big way while they're keeping their focus on profitability. All right, now let's get into some long-term strategies now that NIO is working on, because this is where the company's vision really shines. So Li Bin has laid out a three-pronged strategy that's focused on regional expansion, price range expansion, and category expansion. So what does that look like in practice? First, NIO is expanding its price range. We're going to see them offering cars from 3 different tiers in 2024, covering a holistic range of 140,000 yuan to 800,000 yuan. That's smart because it allows them to target a much broader customer base, from those looking for an affordable EV to those looking for the top of the line, upper echelon electric vehicle. Second, they're expanding their product category. NIO isn't looking to just be a one-trick pony. They're building out a multi-brand strategy, ONVO being a great example. By the way, ONVO is going to be key in taking on Tesla's mass market dominance. With 105 new ONVO stores and the ONVO L60 rolling out soon, we're going to see a serious push into the mid-range EV market. This is definitely going to be a game changer for NIO's growth and trajectory. And finally, we've got regional expansion. NIO's aggressively targeting lower tier cities in China, which is crucial. Charging infrastructure and battery swapping infrastructure is becoming more available in every county. Plus, they're pushing into Europe, which has already opened a store in Amsterdam, and their battery swapping stations are spreading across the continent. What does all of this tell us? Well, NIO's not just focusing on today. They're setting themselves up to dominate tomorrow's EV landscape. Whether it's China, Europe, or beyond, NIO's expanding strategically and methodically. But here's the question that's on everybody's mind. Is all of this sustainable? NIO's still posting a net loss of over 5 billion yuan for the quarter, and although it's down 16.7% year over year, this is something that is definitely worth it to keep an eye on. Can they keep growing revenues, improving margin, and scaling operations while bringing down this loss? I'm optimistic, and I tell you why. NIO's making investments today that will pay off tomorrow. Their production capacity is about to ramp up with the introduction of a double shift by the end of the year. They're even building a third factory that's set to come online by September next year. These aren't moves that a company makes if they're planning to tread water. In my opinion, NIO's gearing up for explosive growth. So where does this leave us? NIO's Q2 earnings report shows a company on the rise. Strong revenue growth, massive improvements in margins, and a bold expansion strategy that covers products, prices, and regions. Sure, they're not out of the woods yet in terms of profitability, but they are building the foundations for long-term success. And as an investor, that's exactly what I want to see. They're aiming for big things: 25% gross margin, 40,000 vehicles per month, and ultimately global dominance in the EV space. That's ambitious, but with the moves they're making today, it's not far-fetched for tomorrow. So let me know what you think. Is NIO on the right path? Are they making the right moves, or is there something that should be done differently? Make sure you hit the like button, make sure you hit the subscribe button. Definitely leave a comment down below. Let me know your thoughts on these things. Click the notification bell icon, hit the subscribe button if you're new here, and we'll catch you in the next installment of the Courtside Financial Podcast. Thank you for watching.